Yeah, I think that these are concerns that are somewhat warranted given the fact that I think that we're continuing to see some compression, particularly in the multiple for long duration stocks. But some of these stocks, if you look at the Qs, for instance, the top 10, Scott, NVIDIA, Tesla, Microsoft, Google, they're all down well more than the market. And so to go back and retrace to February, I mean, we're talking another 20% down for some of these names. They could get it because I think there are some company-specific concerns, and you were talking about that with Jonathan in the earlier segment. But it seems difficult for me to grapple with the fact that all of these names are going to be down another 25-30% from here, especially these ones that are off, well over 70%.
I know, but therein lies the rub on the overall market, right? It's hard to get your arms around the idea that we could go to a dark place. And some of these names that are tried and true and have, led us to the promised land could go to a dark place too.
But what is that promised land? We're oscillating right now, Scott, between the Fed continuing to be aggressive, or we're entering into a recession where the Fed isn't going to be as aggressive. And if we're going into that, whether it's a contraction or a true recession in the back half of next year into 2024, we're going to have to go back to quality balance sheets, free cash flow. I'm not necessarily saying tech, but looking at it in terms of what do you have that is defensible in that environment, that's going to be critical. And I think that at some point, some of these quality names, you're going to start to see that transition. I'm not going to say it's timing it the middle of next year, but the bottom line is that you have to go back to companies that can generate their own growth on the top and bottom line. And some of these names, maybe not all of them, but some of these in the back half of next year are going to become a lot more attractive as we enter into this late stage cycle.
See, those two scenarios which you painted at the top of your answer sound both bad to me for tech. And to the notion that you use the word defensive. Well, let me finish. You use the word defensible, which I think is interesting in and of itself, because these stocks in many ways were viewed as defensive plays in times of market upset, not even like to the degree that we've witnessed, but even in simple upset in the market, people went to these stocks because they were viewed as defensive plays. Yes, they were in a still zero or very, very low rate environment. Right. Now the goalposts have completely changed. So what makes us think that they will be looked at that again?
Well, not all of them will be. And I think that's an important point. If you're looking solely at future cash flows without profitability, those are the companies that did really well in 2020. And those are not as defensible today. But I think if you're thinking about businesses like Azure that are still going to grow, maybe not 35%, but maybe 25%, Scott, in a recessionary environment, doesn't that seem a lot more attractive than buying cyclical businesses such as consumer staples that are going to have margin compression? And perhaps a weaker consumer? I don't know. I think that the tech is dead. The tech is dead narrative is probably in place for the next couple of quarters, but I do think that there are parts of the Qs, parts of technology, parts of maybe not so much communication services that will have light at the end of this tunnel.
All right, we'll leave it there. Shannon, thank you as always. That's Shannon Saccocia.